Hello, welcome to this session, Understanding Property Development, Opportunities, Pitfalls, and Smart Investments. This will give us a background awareness session on property development and will explore the property development landscape as an investment opportunity. My name is Rami. I'm a civil engineer, license builder, degree in engineering management, and I have master degree in finance and acting as a contractor and property developer for more than 20 years. Now we start with our session, part 1. And before we go into the details of the property development as investment opportunity, I would like just to give a quick background about the mindset of any investor, regardless of the option of investment you choose. So I'll start with this little story, which will take some takeaways out of it. About 20 years ago, I was just an employee with small salary as entry level in Dubai, working in a mega project in Abu Dhabi. So going back and forth every day, and then I noticed a big banner announcing a freehold property rent to own on one of the sideways of the freeway. I knew that I couldn't afford this. However, I stopped over and I talked with the sales rep at that time. He explained to me that you need to pay the deposit and then you can move on after handing over, and the rent will be deducted from the total price of this property. I thought it's a great idea. I managed to pay the deposit, which I borrowed actually from through friends and contacts, and then I signed that sale contract. It was the first in my life. But here's the conclusion. In less than 2 years, I made over 20 times more than the deposit I made, because it was the beginning of the trend of the freehold properties at that time. What did I do with the money? At that mindset, now I bought a fancy new car, and then the rest of the money made me to become a developer later on. But it's not the end of the story. The end of the story is the fancy car I bought lost 50% of its value in less than 3 years, while the money I invested to become a property developer, unfortunately, in less than 4 years, I lost all of that money and my savings, and I was in debt for the following 3 years. Why did that happen? And here is the takeaway. It happened because I did not have the mindset of being a successful investor. And here we go. So I'm sure that you know the cash flow quadrant for Robert Kiyosaki, but now I will look at it differently from mindset perspective. So the mindset of the employee is different than the self-employed or the business owner or the investor. The employee, they sell their time in exchange to salary, while the self-employed are individuals, they have skills and they focus more on the system. And as you know, the self-employed, they have much more time commitment in their self-employment than being an employee, but they have more freedom. And then if you upgrade your mindset even further, then you will be a business owner. The business owner will build systems and hire people, delegate duties, and then they focus on growth and development. If you upgrade your mindset even further, then you will be promoted to be an investor. That means the money generates stream of income for you. It's a fantastic development for mindset, And I would like to say here that the most important asset everyone is having is time. So the idea is how you utilize your time in the best way possible to upgrade your mindsets. In this slide, it's just a contrast in between an employee mindset and the business owner mindset. And as you can see that the employee, they focus on aspects that all related to the work itself, not to themselves. While the business owner, they give priority to strategy and they act and they go to create wealth more than anything else. So that mindset shift is which make you shift your mindset from being an employee to be a business owner, and then after that to be an investor. Why we are talking about this while the subject is about properties? Because to be a successful property developer and investor, you have to upgrade your mindset to be on the level of investment mindset rather than being an employee. Here we are not talking about leaving your job. You can keep your job, but if you are looking for investment and another streams of income in such as property development, then you should have this mindset. Here we go. So the mindset map again, as an introduction to our subject, the employee is selling their time and they have fixed mindsets and they focus on job security, while the self-employed, they skill to develop. Business owner, as an upgrade of mindset, they focus on systems to grow. Investors, the top of the hierarchy, they look for opportunities and they look for wealth creation. They are free of choice and then they end up with financial freedom. This map tells us a lot about how important it is to utilize our time and to give attention to our mindset before we start the journey of being a property developer and before even you know the technicalities and the mathematics of successful property development. Now, as we have the right mindset and we upgrade our thoughts and prospects towards investments, then we have different choices, and every choice has its advantages and disadvantages. So we start with the stocks and shares. Those are easy to be part of. You don't need a big capital like properties, while you can start buying shares by as little as $100 per month, for example. And the options you have as either index funds, which means that you buy shares with an index consists of many companies, in such as SP 500, or you go with portfolios, or you choose yourself the company you see it's suitable for you, you do your studies, and then you buy shares with. Now this one is a good choice for entry level, yes, but the problem that it is unpredictable. So if the market, in the case of the index fund, is going down, you go down with them. And if it goes up, you go up with the economy. Now, the second option is fixed interest or bonds. This is lower risk, steady return, and requires little management. But if it is too little, then you have to cross-check with the inflation. We know that the inflation is kind of the purchase power. So if you have $100 today and you want to buy a basket of goods, maybe you need $105 next year to buy the same basket of goods. That's what we call inflation. In other words, the money loses its value by time. That's why keeping the cash at the bank is not a good strategy for a long term. It is maybe if you want to keep this money as savings temporary until you reach the right investment option. Otherwise, in reality, you are losing the value of this money over time. Now, also we have investment options other than the properties. And why we are talking about other options? Because we need to have the contrast, so then we understand where the property are among those options. So we talked about the stocks, and you can liquidate easy, but they are unpredictable. How about the businesses? The businesses here is also you can scale it as you can afford. So if you have a successful business, with one of your contacts, you can buy shares in their business and enjoy the profit if they are doing profits. So it doesn't require full management attention, but your risk is their risk. Now the big question is, the gold is an investment option. Now people, they say that investment is an investment option, but it's in the long run and doesn't give you return on the short term. But also majority of people, they say that gold is a traditional hedge against inflation and it has limited income potential. So if you have no choice at all but to keep the cash at the bank, the gold maybe is a good option. Now back to the properties. The tangible assets with a strong control, can leverage from higher return, requires active management, but offers tax benefits. Now we are ready to go in details with the property development. Now, in any property development, you should assign the goal of that investment in properties. So in Australia, for example, you either develop to generate profits, so then you acquire low, the land I mean, and then you add value by design and build, and then sell for profits. And the term of this strategy is a project term value strategy, means the term of the project is the term of the project is the term of this development style. While the capital appreciation, you are looking for profit, but you are looking at in a long-term basis. You acquire a property and then you wait till it grows and then you sell for profits. The other style is the rental yield. So you focus more on the high rental yield, you rent the property and you enjoy the income through the rent payments as a passive income. Now, in Australia, there are many advantages of being in principal place of residence. We call it PPR. Why? Because you are the owner occupier and you are exempt from the capital gain tax. This style is very good for beginners as well. You pay the deposit, you live in the house will appreciate over time, and the good news, when you sell it, you don't pay any tax. And we will come with the details in a minute. So you should understand that it's very important before you start the journey is to decide on which style you should choose from these options. Now we decide on which style. Do we need it as an principal house of residence, or we need to flip, in other words, just develop and sell, or we need just to do another structure of the ownership for other reasons. Here we go. So the personal is the simplest structure, but you have full personal liability. So it is very good if you have it for your own home. However, my advice in this case, if you have other businesses and you want with liabilities and you want to protect your home from any threat, then you go with a trust, because the trust is like a safeguard for your property, for your home. Why? Because it offers asset protection and flexible distribution options across beneficiaries. So you have the trusts, and then you have the trustee, and those of the trustee will have beneficiaries, and you can distribute the profit when you sell among those beneficiaries, whether they are individuals or they are companies. The company structure, which is the Pty Limited or LLC overseas, provides limited liability and flat corporate tax rate. This is very good for flipping, for finishing the project, selling, so it is for short term. Why this model is good? Because it facilitates crowdfund or many shareholders in the company investments. So let's conclude here. If it is your home, highly recommended to have it as a person. If you have businesses and you are exposed to liabilities, it's recommended to have it on trusts. While if you want just to develop and sell and you have partners, the best scenario is to have the structure as company Pty Limited. Now, after you decide the goal of the investment and the structure as explained, let's talk about the development feasibility. So before you start any development, you must have cost sheet calculations about the land, stamp duties, the legal cost, design, construction agent and subdivision, and others. Because if you ignore any aspect of these, then you ignore that you are losing part of your planned profits. So you apply the formula, you calculate the assets return, and then very important is to add contingencies, and then you can decide whether this project is feasible or not. Let's take an example. So there are many indicators in the market about whether the property development is feasible or not, but I picked here only two indicators. The first one is the return on investments on costs, and the second one is the return on investments on contribution. I explain. So if the total cost, for example, is $1 million and the profit as estimated is 200, so we divide the 200 into the $1 million, and then the profit will be 20%. That considered is a good percent. The second indicator, it talks about how much you contribute, because we all know most of the projects are funded by bank loans or by lenders. So if you contribute only $200,000 or $400,000, and then the profit is 200, then you divide the 200 over the $400,000, and you will know what is the ROI based on your contribution. And here is the magic. If this is high and this is high, then your project is very feasible. If this is low, but this is also high, then the project is making profit with little bit of your contribution. In this case, if you don't have any alternative project and you want to run with profit generation, then you can go ahead. But if both are low, then the project definitely is not feasible. Now, after we do the budgeting and we do the feasibility and we found that the project is feasible, it's worth to highlight in this presentation that some of the hidden cost categories that if you ignore as a property developer, that you lose part of your profit, if not all of your profits. And this is one of the pitfalls that you need to avoid. For example, the site conditions. If you are finding a land in the market less than its market value, then you have to testify why and what is the reason behind that. Maybe you have soil issues or you need rock removals. So it is recommended to do a site testing. It costs you $300 or $500, but saves you a fortune. Council requirements. You might assume that this project will have 3 units on it, but in reality, the council classify this pocket as a low residence area, and you can't build more than one dwelling there. So all of your planning profits will vanish. What to do? Just pre-application meeting with the council. When you negotiate with the builder, there are so many provisional items, or they call it allowances. Are the allowances reasonable? For example, sometimes they put tiles as a $15 per square meter. If this is not logical, then you will have a low quality. So you need to finalize the selection as early as possible. And the contract variation is the same with the builder. In general, you should read the section 32, which is the vendor statement, and it will show you everything. If you don't know how to read it, or you don't understand most of it, then you just ask your conveyancer to explain or to highlight for you the risk assessment on this land based on your purpose. Now, I would like to have a reminder here that PPR, principal place of residence, again, if you add value on the right place and you wait time to appreciate and you sell, then you enjoy to be exempt from the tax, and it is the simplest form for your investments. As this session is about awareness as well, I would like to talk about the off-plan and subdivision risks, also an home and land package. All experts are saying that the home and land package needs much more time to appreciate than any other established property. Why is that? Because usually the home and land packages are presented by land developers or mega builders that they do in bulk. In other words, you have a lot of supply in that area. And if you have a lot of supply over the demand in that area, and of course in advance to the infrastructure around, then enjoying appreciation over time will be longer. This is the home and land package. How about the off the plan? The off the plan, they have also risks. The timing risks. If the land developer promising by 18 months as an example, then they might not finish by 30 months. This is a holding costs from your pockets. Also the developer viability. So the financial health of the land developer is crucial and might damage the awaiting of the planned property for you. Now, also, if you are paying a deposit for the off-plan land, then you must ensure that they go to the trust third-party accounts. The other thing also, most of the people they don't know is about the sunset clause. The sunset clause risk means that the developer, they can cancel their contracts if they can deliver the project, and all of the time waiting for them to hand over the land for you will vanish. Why they do that? Because the land maybe in that area is increasing in its value, and they do transaction from one company to another in order that they will enjoy the appreciation or the increase in value, not you. So it's very risky towards the sunset clause. Now we talk about the building. So again, as a refreshment, we have the land acquisition, and then we'll have the adding value, which is the design, and then the building, and then the selling. Now we are at this stage, which is smart building design. There are things that you need to consider in this area, that the zoning alignment. So it doesn't make any sense to build a very fancy house in an affordable area, and also to make 2-bedroom multi-dwellings, for example, in a fancy area. So you have to match and do alignment the zoning with what are you designing. So you have to also reduce cost by doing value engineering, and also you do your checklists to avoid anything that will obstruct the purchasers from buying your property when it's handed over. Now also the professional engagement. So you pick and choose the designer who is expert in that area, and he knows which style to be designed to suit that area. Now we finish the design, and we will talk about the builder selection. Building is a very risky stage of the property development journey, so you have to pay attention to make sure that the builder has credits. You have to make sure that they are licensed, and the company that you are signing with, they have a valid credited license, and you can check this online. And also you have to make sure that they have enough capacity with the home warranty insurance, because some builders, they sign with you the contract and put you on the waiting lists. Why? Because they don't have at that stage enough home warranty insurance. The other thing that you need to check are their references. Other people will do them if possible, read the reviews and check their products in advance to signing building contracts with them. Also, you need to examine the contracts and focus, as we said, on the provisional sum items or the allowances, and make sure they match the expectations of the sales at that area. Also, assess communication. So you have to evaluate the builder responsiveness and transparency. Now, most of the people, as normal human being behavior, they focus more on communication and they ignore other important aspects. You should give them equally the same importance, because any of those can obstruct and delay your project. Now we finished the design and we finished the building, and the builder handed over the project for us, or we have a property and we are thinking about holding or selling. It's the big question. Everyone is asking about it. Everyone is sometimes at some stage is confused around how to answer this question. So we make it simple. The reasons to hold, in short: strong rental yield, appreciation forecasts, or located in growth corridors, or you have attractions with tax, and you know that there are in the future some infrastructure projects or plans or schools or train stations, for example, and then will boost the property price, and then it will be on higher demand, so there is no reason to sell, and there is big reason for you to hold. In contrast, reasons to sell: if the market be conditions and you have another alternative, we call it trade-off, and then you have other alternative for you to flip or do better in other area, or you have negative cash flow burden, so it's not worth the risk, and the market is give you signals to sell, then you sell, or there is a slow long-term appreciation in this development, there is no point, then you decide to just to sell it. So the key considerations here are capital gain tax implications. You have also to consider the the transaction costs and the market timing risk and future development potential. If we put all these together, then you can decide whether to hold or to sell. But those considerations are not numeric. If we take this example as mathematical example, so maybe it will give us a better idea. I give a simple example here. Let's assume that we have a property and the market value is $600,000 and expected to increase in its value by 8%. So it has a good appreciation rate every year for some reason. The rent is $2,500 per month, then it is about $30,000 per year. However, the expenses are you have maintenance and you have cancel rates, as we all know, and you are paying mortgage of the part of this. And don't get confused here, because if the interest rate is 5%, it doesn't mean that you are paying 5% multiplied by 600. No, because your loan is partial, then the interest rate multiplied by your loan, let's say 400, then will give you $20,000. So you have to put here the real figure you are paying to the bank, not the percentage of the mortgage rate. If you do this, then apply this simple formula. The return is the appreciation rate, which we said 8%, and then the rent yield, which is 5%, so total 13% in blue, minus those expenses, then the return is 8.7%. Then you go to the other question. What is the trade-off? If the trade-off is good and you have better opportunity, then you go ahead. If not, then it's a good reason to keep. Now, we come to the conclusion here with this quick session. So the key takeaways for successful property development. So property development offers significant potential return if you know the game. And it's surrounded by risks, so you have to take care of the planning and you have to navigate challenges in every stage. Always be around with the due diligence and with the expert advices. The bonus tips. You have to know, as you starting the property development journey, that the pathway is equally important to the destination. So being over optimistic is risky actually. You have to think about serviceability, unexpected events, your cash flow, do you have a backup income just in case, and so on. Also, you have to know that your alliances might be your challenges. So the bank will give you a loan, but they need their repayments, and the authorities, they might give you plans of permit, but they need the open space contribution. The agents, maybe they give you a false advice to sell or to hold or to rent to their advantage. Designer, also he needs just to get the approval. While is he giving you the best fit design? That's the big question. The builder also might give you a very affordable contract, but whether he is delivering or not, because some of the builders, they design their profit model into variation rather than the lump sum contract you are signing with. Also, we conclude here that the mindset, including the knowledge and how to budget and how to understand the location and how to do the due diligence, are the main factors to a successful start. Property development, especially in low scale, unfortunately is not the mainstream of income. So if you are a highly paid employee, you take the property development or investment as a secondary stream of income. But to say that you want the full and the only stream of income is out of property development, You then have to be either on a large scale or you are overlapping smaller scales cycles on the same year, so you can consider it as a mainstream of your income. I would like to thank you for watching this short presentation about the big task of property development. Um, you can scan this one and download just a free copy of the presentation, and also here I put some reading suggestions if you would like to. The Psychology of Money, Think and Grow Rich, Rich Dad and Poor Dad, which is a very well-known book, and The Mindset. This is my favorite, and we spoke about it today in order to shift the mindset from one stage to another before you consider yourself as a property developer. Thank you so much for watching, and hopefully we see you in other sessions.